if you're someone who doesn't have a structure, and that example where you have 200,000 no earner, 2 rental properties, that could be a really good opportunity to have a look at your debt and your properties, and we could do a restructure where we put your investments into a new structure. We put as much debt as we can on at the market value, and then we try to reduce the debt on your own occupied house. So that will probably result in the net income coming down, but your outgoings remaining the same. So that's a really good place to look.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Mr. Tax himself, Matthew Harris, here to talk about the 5 tax hacks you need to know.
We're back in your life. And Matthew, you are always in our life, but you are back on the podcast. Welcome back.
Hey, it's good to be here, but I tell you what, Mike, if you call me Mr. Tax again, I'm going to get security to march you out of here.
Yeah. He doesn't know tax return. He doesn't know the difference between his debits and his credits.
Yeah. That I definitely know. They drill that into you so hard at university. Yeah. You can never forget.
Yeah. And if you think these accounting jokes are great, then hang around because it's going to be a banger of an episode. So, Matt, I look at it and I go, New Zealand's tax system, like the States is great, right? Because they're like, if you buy under a car that's under 2,000 tons, it is completely depreciable. Like there's all this stupid, crazy stuff. But New Zealand's tax system is pretty straightforward. So I'm actually quite interested to see what our tax hacks are.
I mean, I'm glad you used the US example because it is wild what they can deduct. But what you got to remember about the US is, first of all, it's a big, crazy place. Secondly, they're dealing with state tax and federal tax. And if you've seen their tax code, and a tax return's like 50 pages long. So you kind of go, yeah, that'd be nice. But also we live in this really simple world in New Zealand.
We're simple men.
We're just simple men, just pulling our debits and credits and getting them right, obviously. You're right. There's very limited things that most people can deduct unless they want to go to the really aggressive end of the sphere, which we're not here to talk about today.
Aggressive.
Yeah. Although we were just chatting about maybe doing something like that. But let's start with some nice simple ones. So this, what I'm going to do is just talk about 5 common ways that are easy enough for the ordinary person who's in business and some people who are employees to get a deduction. The general premise of tax deductions is that they reduce your taxable income. That is a great thing. No one should be trying to pay more tax than they need to. And I'm actually reminded before we start of a really, really good quote from Kerry Packer, who was a tycoon businessman in Australia. And he was famously pulled up in front of a Senate for something. That part I don't know, but I do know what he said when they asked him about whether he evades tax. And he said he absolutely does not evade tax or seek to do so, but he does minimise his tax within the law. And anyone who doesn't would need to get their head read because as a government, they're not spending it well enough for him to donate more.
That's a great line.
I was just like, that makes a lot of sense.
Yeah.
So anyway, first one, Chattels depreciation. So this one is a really good one. In New Zealand tax, there is pretty much nothing left. That's what we would refer to as a non-cash deduction. So that's a deduction for something where you didn't spend money. So in the ordinary course of most things, you spend $1, you get to deduct $1. For depreciation, so that usually applies in relation to property to chattels, for example, which is a really common one. That's heat pumps, carpets, window coverings, dishwashers. There's a huge list of chattels. It's all on the Inland Revenue website if you want to have a good sleep one night. What you can do is that you can get a chattels depreciation report. So that's someone who's very similar to like how a valuer values a house. They will come in, they will literally value every chattel that they can find in situ, and they provide a big list to the accountant. They attach their depreciation rates. They give you straight line and diminishing value, which are the 2 options that you can choose, which will make a difference. And if you want to get really geeky on it, straight line is what it sounds like. It is depreciated evenly over the life of the asset. Diminishing value is depreciated more heavily up front and it reduces over time. So obviously, the time value of money says that you take DV in most cases.
Can I ask you a personal tax question for Mike and I? No one's here. What we're doing. Mike and I just did a little renovation of 12 units in Upper Hart.
Yes.
It just makes me think we didn't do anything in terms of like a Chattels valuation or anything. Do they count because they're like more carpets and kitchens and
Yep. So generally, you wouldn't do a Chattels depreciation right after a renovation. And the reason being is that you've actually got a Chattels list already because you just went and did it all. Carpet, heat pumps, things like that. And generally what the valuers do, because they kind of have like a moral code, which is kind of backed up by the might of the Inland Revenue, which says that you can't do a Chattels depreciation on top of brand new Chattels.
Right. Yeah.
Because you're already going to be claiming that.
right. Okay.
So it's slightly different. Yeah.
We put
Just put the 12 units in your pocket.
Cool.
You did it right, guys. Just chill out.
You're doing okay.
Okay. So we've got the Chattels that we can look at. What else we got?
So next one is motor vehicle expenses. So this is a bit of a difficult one, and that American example is really great because the amount of people that ring us up at the end of the year in their balance date and go, if I buy a vehicle, can I avoid paying tax this year? The answer is no. The way that capital items work is they are also depreciated, similar to a chattel. You do get a GST deduction a lot of the time if you're GST registered, but the value of that vehicle will be reduced over time in your books. So it doesn't quite work like that. But one place that is a really good deduction for people to get, especially if you're a property investor, and we deal with a lot of property investors, is mileage rate deductions. So a lot of people overlook this. They go, I don't have a vehicle, and honestly, if you run one rental property, why would you need a business vehicle? And only revenue know that. But you can get a mileage deduction. So imagine that I live in Auckland and my rental is maybe in Hamilton. This is an extreme example because you probably fly to Hamilton maybe. But imagine I don't even know, how long is it to Hamilton? 100 Ks?
Yeah.
It's called 100 Ks. So it's 100 Ks.
Much love to the Hamilton community.
Yeah. And your airport. Yeah.
If John Colonel's watching, sorry, John, we like Hamilton. It's 100K there and it's 100K back. The mileage rate currently is $1.04 per kilometre. Every year it's published by Inland Revenue. It goes up and down like a yo-yo, depending on petrol prices, inflation, etc. We can effectively claim a deduction for $200 in our tax return. Imagine we do that 5 times a year. We can deduct the whole lot as a deduction against our income. So little things. But in tax and in life, the little things add up to big things if you do them right.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. Maybe this next one's one of the ones that even I get asked about quite a bit. And sometimes people try and really push this one. Matt, what is the next one we're looking at?
Home office expenses?
Home office expenses.
I'm a businessman doing business things.
Yes.
In my home, yeah.
So this is a great one. This is not quite as good as a non-cash expense, but it's very similar. And the reason being is when you claim a home office expense, you would have had to pay that money anyway to live. Because you're going to pay your rental mortgage, you're going to pay your power, your internet, regardless. But with a home office expense, you can get a deduction for part of that in your tax return. So it's a really interesting history of home office deductions, especially if you're an accounting nerd. So there was this guy, Banks was his name, and he was a teacher, but he used to do relief teaching. And he used to mark the papers in his lounge or his coffee at his coffee table or his kitchen. I can't remember the exact things, but something like that. And he put a deduction in his tax return for a portion of the expenses of running his home. Inland Revenue wanted to figure out whether this was going to run or not, so they did a test case on it. So Banks versus Commissioner of Inland Revenue is the test case for home office deductions. And long story short, he won. And that's where home office deductions come from. So it's well within the law to have a deduction for home office. Where I know you're going with it, and the smile on your face tells me that everyone wants 50% of their house. I've got some boxes in the garage, and I use this office completely. And look, the reality is you can try that, but if Inland Revenue finds that, they're not going to be very happy. However, we in this office work on a 10% deduction ordinarily. So grab all your interest costs, all your rates, all your insurance, all your internet, tally it up,
Yep.
10% is the normal. If you can show that, yes, you did more. So some people do have garages full of tools and they have 10, 20 properties and they go around repairing them all the time. We can take another 10% or 15% for your office. But the reality is it's a great deduction. And you should be taking it because it will reduce your taxable income over time. And again, all those little things add up over time.
Yeah, and I love the point you've made there where, there are deductions you can absolutely apply for and should get, and it is well within the law. We are not pushing things to the extremes here to push people outside of the law. That is not what we're saying at all. And I think that's a really important point here is like at some point you're just going to have to pay some tax along the way. No one should be paying any more tax than they definitely have to. But there are, I get asked about it as a mortgage broker with the home office expense. And I'm like, mate, first of all, talk to an accountant. And second of all, at some point, you're going to have to pay some bloody tax.
I thought an accountant's job was what's 1 + 1? And the accountant goes, whatever you need it to be. I thought that was your job.
That's the Cayman Islands.
Yeah. When I worked with Inland Revenue, I used to deal with accountants like that. And that's the thing about it. We have a voluntary compliance system in New Zealand. Everyone has to put in their own tax return. They have to take the correct position. And then it's, you either get looked at or you don't. But the reality of life is that do you want that hanging over your head? I spent a long time working there and I saw the other side of it, hugely aggressive tax schemes and no one ever wins in the end. They end up fighting, lots of legal fees, asset seizures, stuff like that. We're obviously dealing with a lot lower down the chain. And I think this is a great place to play because, you can try and get as much of the stuff as you can. And Inland Revenue's probably not going to spend any resources to come and have a look at it anyway.
Nice. Okay. Any other tips for us, Matt?
Yeah, we've got a couple more quick ones. We don't want to make this a long episode because it's tax. But one quick one. Because New Zealand has this really simple tax system, there's not many deductions that employees can get. So I just want to really quickly touch on those. One of them is a really important deduction for accounting fees. So you can have that one. So if you need an accountant, reach on out. You can deduct our fees. But the other two ones, one is interest on funds borrowed to invest, which would only really apply for stocks and things like that. But the third one, which I wanted to really touch on, is personal insurances. So this is a really important one because covering risk in life is something that I think absolutely everyone should do. Not enough people do it, and unfortunately in our business we see the examples where people have not done it or they have not done it correctly or not enough, and it's terrible. The upside of getting personal insurance, loss of earnings, things like that, is that it is deductible. So if you're thinking about getting insurance and you're worried about the cost of it, but you're also worried about the risk of not having insurance, well, there's some balance to be found there by understanding that you can deduct those premiums.
Yeah, the premium you're paying every fortnight or whatever is not actually the premium that you're paying by the end of the year. But the other thing I'd say on the income protection side is there are ones that are tax deductible and ones that aren't. So just be careful. If you need some help, just reach out and we can help you.
Yeah, definitely. You do have to be careful with that. And the amount of tax that you'll save on that will vary. So the final one is a really, really important one. And this is one where you definitely need an accountant, structuring. So what structure you use, so that's trusts, companies, look-through companies, limited partnerships, individuals jointly owned. Those are the structures pretty much in New Zealand. Which one of those you use will very much depend on what you're doing in business and property and investments, but there can be huge tax outcomes by using the correct structure. And I'll just use a really quick example before we wrap up. Imagine that you are a $200,000 a year income household. One parent is a stay-at-home though, so they earn $0, the other earns the $200, and you have two investment properties making a net rental of $10,000 a year. So the taxpayer who's earning $200,000 would be taxed at 39%, and the taxpayer who's earning $0 would be taxed at starting at 10.5%.
Yeah.
So a huge disparity there. So on that $10,000 income, if you had the correct structure, you could save up to $2,000+ every single year just by having the right structure in place.
And Matt, we've previously talked about in an episode and on a webinar around making sure that the debt we've got against our investment properties is kind of stacked correctly and there were some changes recently, is that something that a structure would help with?
Yeah, definitely. So if you're someone who doesn't have a structure, and that example where you have 200,000 no earner, 2 rental properties, that could be a really good opportunity to have a look at your debt and your properties, and we could do a restructure where we put your investments into a new structure. We put as much debt as we can on at the market value, and then we try to reduce the debt on your own occupied house. So that will probably result in the net income coming down, but your outgoings remaining the same. So that's a really good place to look.
Yeah, I had a client recently who had a $1 million investment property with no debt against it, right? And then from looking at the structure, they saved like, I think, $20,000 a year by changing the structure, moving the debt across. That's a lot of lettuce.
That's a lot of lettuce.
Matt, just before we wrap up, I'm just keen fun one for you. What are the questions you get asked the most, or your team gets asked the most, where you're like, nah, you can't do that?
Oh yeah, so I mean, definitely the motor vehicle one. So often. And I just wish I could, because they watch the videos from America.
Yeah.
They watch the TikTok or the Instagram reel where the guy's going, I've got my G-Wagon and it's 100% deductible to me. And so that one's really common. Other common ones would be related to like overseas travel.
Yeah.
People wanting to deduct the whole trip overseas. And it's like, yes,
I took my family to Disneyland. It's a business trip. Yeah.
There can be business components to overseas travel for sure. But 100% deduction, who goes overseas and spend the whole time working when they got their wife and their kids? And it's like, inland revenue's not dumb.
Yeah.
You might not like your family.
I consider that word.
Yeah.
What about offsetting your income? Do you still get that one?
We get income splitting. Get asked that a lot. That can't be done, although structuring can help you do that. There's one other that's just on the tip of my tongue that I just can't quite.
Personal expenses, like getting mixed into the business and those sort of things.
People don't really ask about that. They just kind of do it.
Better to ask for forgiveness.
Absolutely. Yeah. So there's actually a wide range of things.
Yeah.
And the other thing that's kind of not related, but people do ask about, the good ones ask about, is record keeping. I mean, that's a really good one. If you want to maximize the outcomes of your tax returns at tax time, if you have immaculate records, you get far better outcomes just regardless, because our team can look through everything you've done and characterize it properly, get your deductions where they get them. If you don't have that info, you might have even forgotten. Who can look back a whole year and go, oh, this is what I spent all year.
Yeah, absolutely.
Yeah. Awesome. Okay, Matt. Well, thanks for sharing your top tax tips. Much love to Partners Life for sponsoring this episode. Please make sure to subscribe to the channel, give us a review, give us a like. We'll catch you next time.
Cheers.